Okay, welcome back to the channel. I have been absent over the Christmas. I hope you had a good Christmas and a Happy New Year. So in this video, I'm going to be looking at nicotine pouches and whether they meaningfully changed the investment case for big tobacco. Specifically, we'll focus on what they mean for growth, margins, and valuation, not just whether they're popular or growing. Nicotine pouches have become an incremental revenue stream at a time when cigarette volumes are structurally declining. Most of this growth is driven by substitution rather than, like existing smokers switching formats and quitting smoking or trying alternative products rather than, creating an entirely new demand. There's also limited evidence so far that these products have strong long-term pricing power. So the key takeaway for investors is, they can provide a short-term boost, however, it's unlikely to materially alter long-term earnings trajectory. From an economics perspective, nicotine pouches are actually quite attractive. They tend to have higher gross margins than traditional cigarettes because there's no tobacco farming and logistics are simpler. They also currently face less regulatory friction than cigarettes, although that could change. However, the total addressable market is largely limited to existing nicotine users. In investment terms, these products are margin accretive but volume constrained. All of this sits within a much bigger trend, the long-term decline in smoking. Globally, smoking rates have been falling for decades due to health awareness, regulation, taxation, social stigma, and the demand for smoke-free alternatives has risen as a result, which is why tobacco companies are branching into products like pouches. This trend is directly feeding into long-term revenue growth expectations, more likely revenue decline mitigation. It's important to separate growth rates from impact. Nicotine pouches are growing quickly, but much of that growth is inflated by early low base effects. At a group level, incremental revenues are unlikely to move EBIT in a material way. Markets are also already placed pricing in optimism around next generation nicotine products. So as a result, this growth alone is unlikely to drive multiple expansion. In terms of competition, scale matters. Big tobacco firms control global distribution networks, have deep regulatory expertise, and significant lobbying power. Startups often innovate faster, but they struggle to scale profitably. The most likely outcome isn't disruption, it's acquisition. For equity investors, that limits upside optionality. Regulation is one of the biggest risks here. Potential flavor bans, restrictions on advertising, and increased scrutiny around youth usage could slow consumer switching. From a valuation perspective, regulatory uncertainty increases the equity risk premium. A higher discount rate directly translates into lower valuation. Another key risk is consumer behavior. Early adoption doesn't guarantee habitual use. Nicotine pouches still compete with cheaper alternatives like vapes and nicotine gum, and brand differentiation is limited. So for investors, the key metric isn't trial, it's repeat usage and retention. In a bullish scenario, continued switching away from cigarettes, regulatory stability, and strong execution could support revenues. In a bearish scenario, tighter regulation, health concerns, and competition from other nicotine alternatives could dampen demand. The base case sits somewhere in between, modest support, but no structural growth shift. Investors should focus less on headlines and more on fundamentals. Key things to watch include segment revenue growth relative to cigarette decline, management commentary on earnings calls, regulatory developments in major markets, and evidence of sustained consumer adoption. These factors tend to drive short-term sentiment, but fundamentals drive long-term value. To sum up, nicotine pouches offer a temporary revenue boost for tobacco companies. They are strategically sensible and margin positive, but they don't fundamentally change the long-term picture. Ultimately, they function as defensive earnings lever rather than a structural growth engine. In the short term, they're interesting, but in the long term, the impact remains limited.